Every video about paying yourself from your business focuses on saving taxes. That's important, but it's not the most important question. The real question is, will this hold up when someone looks? You've Googled it, you've watched videos, you've heard people talk about owner's draws, distributions, reasonable salary, and everyone seems to say something different. Meanwhile, you're focused on running your business and serving customers. You move money when you need it. You assume your CPA handled it, but when a lender reviews your books, or the IRS audits, or a buyer does due diligence, will your setup make sense, or will it raise questions? When clients come to me, this is usually what they are worried about. They want to know, did I pay myself the right amount? Did I pay myself the right way? And did I pay myself at the right time? I am Aldo Leal. I'm a licensed CPA, and I come from a corporate finance background where every number gets scrutinized, so every number needs to make sense and be clear. In this video, I'll walk you through 5 steps to paying yourself the right way and avoiding the mistakes I see that don't hold up. Step 1, know your entity type and payment method. The first thing you need to understand is how you're allowed to pay yourself based on your entity type, because they're not all the same. Single member LLC, which is a default setup, you take owner's draws. You transfer money from the business to yourself when needed. You're taxed on the total business profit for the year, regardless of how much you actually took out. Multi-member LLC or partnership. You take distributions based on ownership percentage unless the operating agreement says otherwise. If you're actively working in the business, you may also take guaranteed payments, which functions like a salary for partners. S Corp or LLC taxed as an S Corp. You pay yourself in 2 ways, a W-2 salary for your work and distributions for ownership. This is where potential tax savings come from, because distributions aren't subject to self-employment. But there are rules, and we'll come back to those in step 5. The mistake I see most often is not matching the payment method to the entity type. I see S Corp owners taking only draws, like they're still a simple LLC. I see partnerships ignoring their operating agreements. When the payment method doesn't match the entity structure, it raises questions immediately. Step 2, separate business and personal completely. This sounds basic, but I see it all the time. Business income going into a personal account, personal expenses paid from the business card, money moving back and forth with no clear logic. This is called commingling, and it's one of the fastest ways to create problems. From a legal standpoint, the whole point of an LLC is limited liability. Your personal assets are protected if the business gets sued. But when funds are commingled, a court can pierce the corporate veil and go after personal assets anyway. From an accounting and tax standpoint, commingling makes your books very hard to review cleanly. The IRS cannot tell what's business and what's personal, so everything gets questioned. I often see this start innocently. Someone opens a business but keeps using their personal account for now and never fully separate things. The fix is simple: complete separation. Business account for business, personal account for personal. Owner pay is the only bridge between them. The mistake is using the business account like a personal checking account and saying, I'll sort it out later. In practice, that almost never happens. And when someone looks, it's a mess. Step 3, pay yourself on a consistent schedule. Here's what messy books often look like. $2,000 transfer on the 3rd, $800 on the 17th, $5,000 the next week. There is no pattern. When a lender, auditor, or buyer reviews your books, they're looking for a story that makes sense. Random transfers don't tell a story. They raise questions. One of the first things I do when I take on a new client is review the general ledger for patterns. When there is no consistency, I have to spend time with the owner reconstructing intent. That's not what you want. You don't need to pay yourself like a traditional paycheck, but you do need a pattern. Monthly on the 1st, bi-weekly on the 15th, quarterly distributions. The amount can vary with cash flow. The timing should be consistent. The mistake is the whenever I need it approach. To a lender, that looks like a lack of financial discipline. To an auditor, it signals something worth digging into. Step 4, document every payment every time you pay yourself. It should be recorded properly. Date, amount, category, and a brief note if anything is unusual. Whether it's an owner's draw, distribution, salary, or guaranteed payment, because when someone asks, what was this $3,000 transfer on March 15th? You should have a clear answer backed by record. Save digital receipts, scan paper receipts, add notes when booking entries. For S-Corp specifically, this means real payroll records, pay stubs, quarterly 941s, state filings, W-2s. If you're calling something a salary, but there's no payroll documentation, it's not a salary, it's a draw. And the IRS knows the difference. The mistake I see here is unexplained transfers. When I see transfer $4,500 with no context, that is a red flag I have to investigate. And so will anyone else reviewing your books. Step 5, get the amounts right. This is where S-Corp owners most often run into trouble. If you've elected S-Corp status, you must pay yourself a reasonable salary before taking distributions. People hear that distributions aren't subject to self-employment tax and think, pay myself a small salary and take the rest as distributions. But the IRS actively looks for this. If your business earns $200,000 and you're paying yourself $15,000, that doesn't pass the smell test. If the IRS determines your salary was unreasonably low, they can reclassify distributions as wages and assess back payroll taxes, penalties, and interest. So what's reasonable? Your salary should reflect your role, your industry, your location, and how much you actually work in the business. My general framework is simple. Define your role as if you were hiring someone and look up what that role pays in your market. Another piece people forget, tax reserves. If you're a pass-through entity, you owe taxes on profits whether you distribute them or not. I often see owners pay themselves everything, then scramble at tax time. A good rule of thumb is to use last year's effective tax rate as a starting point and adjust if income is growing, or work with a CPA to estimate quarterly payments. If you've been doing some of this wrong, it doesn't mean you're in trouble. Most of this is fixable. I regularly work with clients who come to me with years of messy books. We clean them up, get everything classified correctly, reconcile accounts, and move forward. If you're wondering whether your setup is defensible, ask yourself, can I explain every owner payment? Do I have documentation to back it up? Does my setup match my entity type? If you're not sure, that's worth a conversation. Know your entity type and payment method. Separate business and personal completely. Pay yourself on a consistent schedule. Document every payment. Get the amounts right and plan for taxes. When you do this, your book tells a clean story. You're not winging it and hoping for the best. You're running a defensible operation. Clean, orderly, easy to follow books are the foundation of a well-run business. If this was helpful, please subscribe. I make videos for business owners who want to actually understand their numbers. If you have questions, drop them in the comments. And if you want someone to review your setup and tell you what's solid or what needs to change, I offer consultations. Check the link in the description or scan the QR code. I'll see you in the next video.